this bubble is ripe to pop overnight. Prices were marked down very, very heavily. Now, I would suggest that there is some indigestion, if you like, in the Shanghai futures market, Shanghai Gold Futures Exchange. Overnight, we've seen this a few times during Shanghai trading hours. So that indigestion was continuing, and it drove down gold and silver quite hard. Not much volume. Is indicative of a squeeze on the swaps. I think they are being very, very badly squeezed.
In today's news recap, gold and HQLA correcting misleading online information. There have been inaccurate reports online that gold will be reclassified as Tier 1 HQLA, high-quality liquid asset, under Basel III as of July 1st, 2025. This information is not correct. No official announcement has been made or is expected on gold gaining HQLA status. Why is there confusion? There's a lot of online misinformation about Basel III more broadly. Related to gold specifically, various websites state that gold will be reclassified as Tier 1 HQLA on July 1st. Let's pause here. Tier 1 refers to capital rules that were written in the original Basel Accord in July 1988, which became known as Basel I. HQLA is a function within the liquidity rules of LCR and NSFR, which were first written into Basel III and implemented by Basel on January 1st, 2019. People are getting mixed up between capital rules and liquidity rules. LBMA is advocating for gold to be reclassified as Level 1 HQLA. Again, note this isn't Tier 1 because HQLA relates to a liquidity rule. A lesser number of articles say that gold is due to become Level 1 HQLA. But again, this isn't correct. As stated above, no announcement has been or is expected. Gold is already a Tier 1 asset under the Basel Capital Accords, meaning that it has a 0% risk weight. This is true for all three Basel Accords. The rule states that gold held in a bank's own vault is deemed as a Tier 1 asset with a 0 risk weighting. Nothing has changed since the original Basel I Accord was created in 1988. Gold is not due to be reclassified as a Level 1 HQLA. If it were, we and the WGC would be the first to shout about it. LBMA continues to advocate with the central bank and prudential regulatory community that gold meets all criteria to warrant HQLA status. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, turn on notifications, and check our new Numismatics Handbook. Most stackers want to get active, but swapping their metals for dollars isn't an option. There's plenty of opportunities in the overlooked numismatics world. Mastering U.S. coins, key dates, and errors pays off by multiplying your ounces and capitalizing where others aren't paying attention.
The liquidity has very much come from leasing, central bank, leasing of central bank gold. I mean, that was clear, and it was proved by the fact that bullion banks were queuing up to take gold out of the Bank of England vaults. I mean, these are banks which have accounts with the Bank of England. So it's possible for them to store some of their gold there, but they would tend not to. Therefore, at least a large amount of the gold that came out of the Bank of England was effectively leased gold, and it was taken by bullion banks who were benefiting, if you like, from the spread between futures, which were trading at a huge rate, interest rate premium. By interest rate, I mean compared with the gold lease rate. It was a simple interest rate arbitrage. Now, that has now stopped. And if you look at the COMEX warehouse gold stocks, they've now begun to decline. So that process is over. Furthermore, it was only week before last, I was in London visiting someone in Throgmorton Street. Behind the Bank of England, the doors were firmly shut. There was nothing going in or out. So I think that process is over. But it does raise the question, quite rightly, that, how much liquidity is actually left within the system here? Because we get vault reports from LBMA authorized vaults, as it were, and they have declined a little bit, but not hugely. But most of the gold there is owned by someone, as opposed to being, if you like, the liquidity for the bullion banks to draw upon. So it's an interesting, it's a question we would all like to know the answer to. My guess is there is less liquidity there than the numbers would suggest. Quite a lot less liquidity. I wouldn't be surprised if we're looking in the hundreds of tons rather than the thousands of tons. So, and this is very important, given that the demand from China and other East Asian nations, seem to be continuing apace. They're continuing to get hold of virtually every ton of gold that becomes available. So, yeah, the liquidity situation I don't see really improving.
In today's news recap, price pullback spurs gold demand in top Asian hubs. Physical gold demand improved across most key Asian hubs this week as a pullback in global prices sparked buying interest among consumers. This week, Indian dealers were offering a discount of up to $34 an ounce over official domestic prices, inclusive of 6% import and 3% sales levies, compared to last week's discount of up to $16. Demand was better this week compared to last, thanks to the price drop. But a lot of buyers are still waiting it out, hoping prices dip even more, said a Kolkata-based bullion dealer. Prices need to settle down a bit. If gold drops another 2,000 rupees and hovers around 90,000 rupees, we could see demand really take off, said a Mumbai-based bullion dealer with a private bank. Spot gold trading around $3,216.17 on Friday. It hit an over 1 month low of $3,120.14 on Thursday and is set for its biggest weekly decline since November. Dealers in top gold consumer China charged premiums of $9 to $50 an ounce over the global benchmark spot price, compared with premiums of $42 to $49 last week. The correction in gold prices has for sure encouraged some bargain hunting and a good entry point for those who may have missed the move higher, said Ross Norman, an independent analyst. We expect jewelry demand to stabilize over the coming quarters. Retail investment demand will likely be strong, given the compelling investment case for gold, ANZ said in a note. In Hong Kong, gold was sold at par to a $2 premium, while in Singapore, gold traded at par with the global benchmark to a premium of up to $2.50 per ounce. In Japan, bullion was sold at a premium of 25 cents to 50 cents. Now we'll show you the best clips of the latest interview. Don't forget to like, subscribe, and turn on notifications so you do not miss out our daily recaps. And check goldsilverstacks.com to get your Stacker's Handbook, the ultimate guide to stack gold and silver, packed with strategies to trade the gold-silver ratio and get more ounces and build wealth over time, so you don't have to rely on market commentators to make your investment decisions. Enjoy the episode.
The first question about as to whether the LBMA and the Bank of England refused to send any gold over to the other side of the Atlantic. I don't think that's quite the way it works. Basically, if you have gold or you have leased some gold and the opportunity is there, that is what drives the move over. It's actually got nothing to do with the LBMA, so long as the members of the LBMA behave within its rules and regulations. As far as the Bank of England is concerned, there is a problem because if you lease gold, then that gold is your property over the duration of the lease. And it could be that if you lease gold, say for, let's say 5 years or something like that, which not unusual, I would suggest, then you can pass that gold on to other people, rehypothecate it. Because, why do you have gold? You have gold basically as a bank to use as collateral, to collateralize deals. So I think from both the LBMA and the Bank of England's point of view, they're rather limited in terms of what they can do to discourage gold from flowing across the Atlantic. The market would probably do it, if you like, insofar as if there is a shortage of gold in London, then the lease rate should rise. And that might generate a bit of interest, if you like, to get gold back. And if you look at the last vaulting figures, I think I'm right in saying that the Bank of England numbers were down a little bit, but the LBMA numbers were up a little bit. Now, it's not the total thing, because the LBMA vaults, which are recorded, are vaults within the M25, which is the circular motorway that goes around London. There are other vaults outside, I guess. And also, of course, we've got other vaults in other parts of the world, particularly places like Switzerland and so on. So, this is just part of the whole situation, as it were. And I think it would be a mistake to read too much into fault moves, if you like, changes in faulting levels in London and also in the Bank of England. Well, so far as we are aware, the Treasury is not involved with this movement of gold at all. If it was, then this gold wouldn't be appearing in the COMEX warehouse statistics. And furthermore, I think that anything that the US Treasury does will not be divulged. So we really cannot draw any conclusions at all. All we can do is drum up some conspiracy theories. And that's not something I'm really prepared to get involved with.
What's your take on Alasdair's view that real wealth is built when sentiment is low and opportunities are overlooked? Do you believe we're entering a new commodities supercycle like Macleod suggests, driven by years of underinvestment and tightening supply? Or do you think the recent rally is just the top and a major bear market for gold and silver could unfold now? More importantly, how are you positioning yourself? Let me know in the comments. I genuinely want to hear your perspective. Now check this video right here because it's a perfect fit for you, and I'll see you on the other side.